Testing 1 2. Testing 1 2. Hello, hello. Testing 1 2 1 2.
Okay, folks. So let me start with the two questions again. Who is not part of a group yet? Anybody not in a group yet? Hey, this is good. Everybody's in a group then. Okay. Second question. How many of you have not picked a company yet? I mean, you can be honest. I'm not going to pick on you. Okay. Here's my advice. Pick a company soon. Don't sit there going back and forth. It's better to pick a company and change your mind and change the company later than to not pick a company at all. So you have that freedom to change your company. So pick a company soon. Right? Couple other things. One is, as you know, as you probably saw in my email yesterday, the Apple valuation is live online, and says. In fact, I did the valuation about 20 minutes before I emailed you, so it was as fresh as it can get. It was after close of trading yesterday, so jump in and give it your best shot. As I said early on, you might say, look, I'm not comfortable yet. It's okay. Change what you're comfortable changing. I think we're up to like 40 or 50 people already in the Google shared spreadsheet. So let's see if we can make it a couple of hundred at least. Right? The other is after today's class, I'll send out my first weekly challenge. And I don't know whether I told you about this, but this is where I'll push you to take what we've learned this week into something that is a little more testing. So you get the first weekly challenge. You didn't sign up for this, right? Emails every day. I keep harassing you. You still have a chance to drop the class if you want to, but I will keep doing this. I'm not going to stop. So let's pick up with our start of the class test. Just as I said, last class and the last two classes, we've started with the test. Let's start with the test. And today we're going to talk about risk-free rates. So here's my first question. Let's say you're valuing a Brazilian company, and you have a choice of valuing it either in Brazilian reais or US dollars. The risk-free rate in Brazilian reais is 7.5%. The risk-free rate in US dollars is 2.5%. So it's a given. Risk-free rates vary. In which currency will you get a higher value for your company? Okay, think about it for a moment. Same company. I have two different currencies, US dollars or Brazilian real. I've given you the risk-free rate. The risk-free rate is much higher in reais than in dollars. You don't have to answer me because later in today's class we're going to see the answer to the question. Let's see if your answer matches up. So make your choice. Okay. In much of Latin America also you have a choice between valuing a company in nominal terms. So you build inflation into the numbers, or in real terms. Okay? If you're choosing to value a company in nominal real terms, right, which one will give you the higher value? Using real terms because you'll have an even lower real risk-free rate. In nominal terms because you're going to have inflation help you. Or maybe you should get the same value. So different currencies, nominal or real. So basically the point I'm asking you is, will changing currencies affect my value? Will going from nominal to real affect my value. Give it your best shot, right? Now, right now, as I said, I'm not looking for right answers. Now let's turn the page. A lot of you are going to be valuing a company in US dollars. Why? Because many of you are going to be doing US companies, so you're going to use US dollars as your base of reference. And the risk-free rate, as we will see in class today, we're going to use the US Treasury rates, and we're going to use the T-bond rate. Okay? The T-bond rate today is about 2.63% yesterday. It was at the close of trade yesterday. That number is low. Relative to what? Relative to what it used to be. For most of you, it doesn't sound low. You know why? Because in your lifetime, this is all you've seen, is 2 to 3% rates. I tell people, you tell me what you think a normal risk-free rate is, I'll tell you how old you are. Because you tell me it's about 7%, you've been around way too long. You came in, what, in the 1980s? If you think it's about 5%, you probably came around 2000, 2001. But there are a lot of people. This is actually something you will hear from older traders, older investors. The risk-free rate is low. And the culprit is always the same. It's the Fed that did it. We'll talk about how empty that argument is. But because the Fed's been doing, QE1, QE2, Titanic, et cetera, all these superliners, rates are low. True or false? Okay. I don't think the FOMC meeting is today, but it's in the near future. It's, let's suppose they get together and they've been talking about raising rates back to more reasonable levels. If the Federal Reserve decides to raise rates, does that mean Treasury rates will go up? So what I want you to think about is what rates does the Federal Reserve actually set? Because there is this misconception, especially if you watch CNBC long enough, that, in fact, I'll give you about 6 or 7 years ago, I took my, I went with my wife and 2 of my kids, my younger kids, to the Federal Reserve. It's actually neat. They have this neat trip. They take you through the building and they show you the mint downstairs and big stacks of coins. That's the most exciting part of it. So we walked into the Federal Reserve. This young 23-year-old guide comes up, and I almost made myself persona non grata by asking her a question. I said, can you take me to the interest rate room? Because from listening to CNBC, I'm convinced there must be a room that Janet Yellen goes into, say, I'm going to make the T-bond rate higher, the T-bill rate lower. I mean, you have this vision of the Fed controlling interest rates. So I want you to think about, does the Fed, so the Fed meets and says, we're going to raise rates. Does that actually translate into higher T-bond rates, T-bill rates? It might, but I want you to know what you think, so in terms of priors. So we're going to try to answer that because that's a broad agenda for today. We're going to talk about risk-free rates, and in the process we've got to talk about, are risk-free rates too low? Does the Fed keep them there? Does the Fed affect rates? All these things that, if you listen to the financial press, seem obvious. Of course the Fed sets rates. Of course they get together and decide whether the T-bond rate should be 5% or 3%. Let's see if that's true. So I'm going to, as I said, answer those questions, but let me go back to where we left off in our main packet. And this is going to be the start of our discussion of discount rates. So let's start off with what a risk-free investment is. Let's go back to basics. For an investment to be risk-free, you need to know exactly what you will make guaranteed. There can be no uncertainty about it. So I'm going to argue there are 2 conditions you got to meet for something to be risk-free. The first is the entity issuing the security has to have 0 default risk, no default risk. Because even if there's an iota of default risk, it's not risk-free. So that's the first requirement. There can be no default risk. Second, there can be no reinvestment risk. Let me explain what I mean by that. Let's assume you have a 5-year time horizon and you want something risk-free for 5 years. If you go buy a 3-month T-bill, even if you believe the US Treasury has no default risk, and that's an assumption, is a 3-month T-bill risk-free if you're looking at a 5-year time horizon? Why not? At the end of 3 months, what do I have to do? Reinvest it. At what rate? I don't know. So a 3-month T-bill is definitely not risk-free if you're looking at a 5-year time horizon. Would a 5-year Treasury do the trick? I'm getting closer, right? But even a 5-year Treasury has a problem. Every 6 months, what do you get on the Treasury? You get a coupon. That coupon has to get reinvested. Remember, you don't need the money for 5 years. So if I want something truly risk-free, if I'm a purist, I have to take the 5-year treasury and I have to take all the coupons. It's called stripping the coupons. I've got to strip the coupons out. And when I strip the coupons from a 5-year treasury, I end up with what's called a 5-year zero coupon bond. If I were a purist, I've just opened a Pandora's box. Because you get a risk-free rate then for 5 years, what do I need? I need a 5-year zero. To get a risk-free rate for my 4th year's cash flow, I need a 4-year. Do you see my risk-free rates, if I'm a purist, are going to be different for every year, depending on when the cash flows come in. So I'm going to lay, with those foundations, I can already make some general statements about risk-free rates. First, if you ask me what's a risk-free rate, I can't answer the question unless you tell me over what time horizon. It's kind of silly to answer, what's a risk-free rate? Okay, over 3 months I can give you a number. 5 years I'll give you a different number. 10 years I'm going to give you a different number. Second, if you ask me what's a risk-free rate, and even if you give me a time horizon, I cannot give you an answer unless you tell me in what currency. Because the risk-free rate in dollars is going to be different from the risk-free rate in Swiss francs, is going to be different from the risk-free rate in it. There is no one risk-free rate that cuts across. And third, at least in conventional practice, the way I was taught, when I did my MBA way, way, way back in time. You know how much time we spent on the risk-free rate? I think a minute and a half. We were told to use the US Treasury rate as a risk-free rate, and we moved on. Shows you how dollar-centric my MBA class was. But it also shows that people didn't think through the concept of what a risk-free rate is. And they assumed that if you have a government bond rate, it must be risk-free. Is that a safe assumption? What is it that so why do people use government bond rates as default free? Is it because governments are incredibly well-run entities? What does the government have as a power that should protect it from default risk that none of us legally does? The ability to print money. Taxes, forget about it. You can't collect enough taxes to pay. But you can print money. I don't think we can legally put a money press in our basement and say, oh, you know what, I'm running out of cash. Legally, you can't do that. So the only reason government bonds have been viewed as default free is because of the power of the printing press. We're going to argue today that just because you control a printing press doesn't mean that you don't default, even in the local. I'm going to give you data to suggest that even in the local currency, governments sometimes have default risk. And if they have default risk, you can no longer use the government bond rate as your risk-free rate. So let's start with those foundations, and I'm going to ask you a series of questions. And these are not going to be tough ones, but I want you to think through the answer, because as you go think through the answer, you're laying the foundation of how to think about risk-free rates. I'm going to value a company in US dollars. And I'm looking for a risk-free rate to use in my valuation. I decided to turn to the US Treasuries. Let's assume for the moment that the US Treasury is default free. You see why it is an assumption? Because we are assuming the US Treasury will always print the money to pay off the bonds. Let's make that assumption. Now I'm going to ask you some questions about which US Treasury I should focus on. And I'm going to focus on a subset. There are like dozens and dozens of US Treasury bonds out there. I could use a 3-month T-bill. I could use a 10-year T-bond. I could use a 30-year T-bond. I could use what's called a TIPS rate, which is an inflation-protected treasury bond. And the numbers are all different. They range from 0.88% for the TIPS rate to 3.22% for the 30-year T-bond rate. Or maybe the answer is none of the above. So the question is about valuation. What should I use as my risk-free rate in a US dollar valuation? Okay. Short-term treasuries, medium-term treasuries, long-term treasuries. Anybody want to hazard a guess? Yeah. If you are a purist, the answer is actually E. The answer is none of the above. Give me the cash flow, I'll give you what? But that's going to be a pain in the neck to do, right? Think of the Excel spreadsheet you got to set up. You can no longer use the present value function in Excel anymore because each year will have a different risk-free rate. So let's say we want to avoid that pain. We have so much pain coming anyway in terms of estimating margins and revenue growth. So we want to do an approximation. We want to pick one rate. If you had to pick one rate, so you're right, the technical answer is E. But let's assume we want to do an approximation. The approximation going to be the short-term rate or the long-term rate? And tell me why.
It's locked in and you can use.
Let's not go there. Everything's locked in. My 3-month T-bill rate is locked in for 3 months.
It's just assuming whatever you're doing, whatever project you're doing is going to.
What did I say? What was I doing this for? Valuing a company. When I value a company, how long do my cash flows go? It's really forever. We stop in year 10. Our cash flows are really long term, so our risk-free rate has to be really long term. Left purely to that choice, I should go with the 30-year T-bond rate. It's the longest term rate. You're going to see me use the 10-year T-bond rate, and I'll tell you why. It is true, purely driven by duration, that I should be using the longest term risk-free rate. But the 10-year rate I'm going to use for 2 reasons. One is, it is the freshest rate. It's the most heavily traded U.S. Treasury bonds. I'm going to get liquid update. The 30-year bond does some strange things because sometimes Japanese insurance companies come and buy it, so you get this. The second is, I've got a whole host of other numbers I've got to estimate, risk premiums, default spreads, and those numbers are all going to be easier to estimate with a 10-year rate. Finding 30-year default spreads is really tough to do because there are very few 30-year corporate bonds, but I can find 10-year corporate bonds. So I want a long-term rate. But I'm going to stop at the 10-year rate because it makes the rest of my life easier. And it's still an approximation because I'm applying the 10-year rate as my risk-free rate on my year 1, year 2. But you know why I'm okay with it? If you look at a DCF valuation of a company, the cash flows are not even across time, right? They're low in the early years, and of course you have that big terminal value. And so I know that because my cash flows are back-ended, that the real effect is in my longer-term rates. So there's a very long justification for why I use a 10-year bond rate. But you're going to run into this in your job. There's going to be some guy that says, but you should be using a 30-year bond rate. Have your arguments ready. He's right technically. The 30-year bond is a longer-term bond. It should be better suited. But then ask him how he's going to come up with default spreads for the cost of debt because you need the rest of it. Because this is a pragmatic question. What do I need to do to get the best estimate of cost of capital? I'm going to go with the 10-year bond rate. And we are implicitly assuming that the U.S. Treasury is default-free. 30 years ago, there would be no debate about it. Of course the U.S. Treasury is default-free. In 2012, during the summer of 2012, S&P actually downgraded the United States from AAA to AA+. It was a huge deal. People acted like the world had ended. I was on a cruise. I get a call from from Bloomberg or one of the, what happens tomorrow? I said nothing. It just means that you can't use the U.S. Treasury bond as your risk-free rate. So what should we do instead? I said what we've been doing for the Indian rupee and the Indonesian rupee and the Brazilian real, you got to do with the U.S. dollar as well. So we'll get to what to do if you don't believe this presumption that the U.S. Treasury is default-free. But to the extent that you feel you're close enough to default-free, you're going to use the U.S. Treasury rate as your risk-free rate. In the aftermath of the 2008 crisis, I started writing a series of papers that I call my nightmare papers. So first of the papers I wrote was, what if nothing is risk-free? Because in that last quarter of 2008, we learned that things we thought were guaranteed, safe places, didn't look safe anymore. It's entirely possible that 10 years from now, nothing will be default-free. In which case we have to some adjust. It's not the end of the world. We have to learn to live with that. But at least for the moment, I'm going to assume the U.S. Treasury is close enough to default-free that if you ask me for a risk-free rate in U.S. dollars, I'm going to give you the 10-year bond rate. Now let's make this a more interesting challenge. Anybody planning to value European companies? No? Come on. There are no companies in Europe that interest you? Yeah? What company are you planning to value? Oh, an Italian startup. Perfect. Right? And what currency are you planning to value it in? Euros. Okay, so you need a euro risk-free rate. So let me help you out here. Here are the 10-year government bonds in euros. But I have a dozen governments that issue bonds in euros, including the Italian government right there, 2.91%. So I don't mean to pick on you, but would you want to use the 2.91% as your risk-free rate in valuing the Italian company? Why not? It is a government bond rate in euros issued by the Italian government. What makes it? It's actually a very simple answer. What are you looking for? Something risk-free, right? There is a default risk in that bond. How do we know? Because these are not Italian lira bonds, these are euro bonds. And there's a German euro bond out there with 0.2%. The extra 2.71% is for what? I'm worried about the fact that the Italian government is going to default. You're saying that's not fair. That's a different argument you can have with the market. But it means to value an Italian company in euros, your risk-free rate has to be 0.2%. 0.2%. And you're going to scream and say, oh my God, this company's Italian, I want to punish it. Don't worry, I'll give you plenty of places to punish the company for being Italian. The risk-free rate is not the place to do it. So if you're valuing a company in euros, whether it's Italian, Spanish, or Greek, the risk-free rate will be the German euro bond rate. Let's move forward. Now I want a risk-free rate in Indian rupees. Anybody planning to value an Indian company? No? Okay. I'll value a few somewhere along the way. And you want to value the Indian company in rupees. You want a risk-free rate in rupees. On January 1st, 2019, I found an Indian government bond, a 10-year bond, a rupee-denominated bond, with a rate of 7.43%. I'm home free, right? I've got my risk-free rate, but before I use it as my risk-free rate, what do I need to do? Stop and check to make sure the Indian government is default-free. Now, I could ask people, but I'm going to get nonsense back. So I cheated. Here's what I did. I went to the Moody's website, and there's a link to what's called sovereign ratings. Sovereign ratings are ratings that Moody's attaches to countries, just like they would do for companies. If you're familiar with bond ratings, they run from AAA all the way down to D. Countries have ratings. And actually, if you open that page, the sovereign ratings page, and I'll send you the link to that page in the email after today's class, you'll see two ratings for every country. A foreign currency rating and a local currency rating. You're saying, why two ratings? The foreign currency rating is the rating that Moody's attaches to India when it borrows money in US dollars or euros, or foreign currency. The local currency rating is the rating that Moody's attaches to India when it borrows money in rupees. I was hoping, I was praying, I was hoping and praying and praying and hoping that I'd see a AAA rating under the local currency rating. Because if I saw a AAA rating, you know what I'd have done? I'd have used the 7.43% as my risk-free rate and blame Moody's if something went wrong. What I saw instead was a Baa2 rating. Not a terrible rating, but definitely not AAA. So what's Moody's telling me? That there is a chance that the Indian government will default in rupees. Last time I did this in Mumbai, half the audience almost got up and left. They said, oh, why would you say that? You know, they can print more rupees. That's a law. In fact, that's the pushback I get every time I open this door. They say, but why would a government that can print money and pay off its debt ever default? And I have to respond with data. You know, half of all sovereign defaults in the last 30 years have been local currency defaults. The Russian government, in fact, in 98, defaulted in the local currency, on the ruble debt, and paid off their foreign currency debt. But that's Russia for you. Because all the domestic debt was, what are you going to do to me? Half of all defaults, sovereign defaults, in the last, that's a puzzle, right? I mean, why didn't they just print the money? Why would they choose to default? It's true, you could print the money and pay off the debt, but is there a consequence to running the printing presses a little faster? You're going to get high inflation. In other words, you're caught between a rock and a hard place. Would I rather default, or would I rather debase my currency? And what Latin America has taught us is it's a lot easier to come back from default than it is from debasement. Let me give you two examples. Brazil had hyperinflation in the early 1990s. You know, for 17 years after the hyperinflation, no Brazilian entity, government or corporation, would issue long-term bonds in reais because nobody would buy them. Because when you have hyperinflation, that's what happens. People lose faith in the currency. In contrast, how many times has Argentina defaulted just in the last 17 years? When I was in Uruguay a couple of months ago, and they asked me, what do you think about Argentina? I said, it's like having a crazy alcoholic uncle live in the attic. He's very nice when he's around, but sometimes he just goes crazy. Every 5 years, the country defaults. You'd think by now people would have given up. 2016, I was in Argentina. It was like the second coming of whatever. People were swooning over the country. There's time to come back. They seem to have forgotten. The amnesia that people have about defaults is just amazing. And countries have learned this. So what does it mean? Just because you have a government bond rate in the local currency doesn't mean it's default free, because governments do default in the local currency. Which then opens up the question, if you open that door, then the 7.43% is no longer a risk-free rate, right? So what do I need to do to make it risk-free? I need to take out of that what I think is due to default risk. And I'm going to try. Remember that Moody's rating of Baa2? I have a lookup table, and I'll tell you in a few minutes how I came up with that lookup table. If you tell me the sovereign rating for a country, I can guess how much default spread you will pay. And with a Baa2 rated bond, the default spread is typically about 2.15%. So a typical Baa2 bond has a 2.15% default. Let's do some algebra. What's Indian government bond rate? 7.43%, right? 2.15% of that is for default risk. So if I ask you what the risk-free rate in India is, let me give you some choices. You can just close your eyes. Since it's a government bond, I'll just use the 7.43%, which is what 95% of Indian equity research analysts, probably 99% do. The second is that you add the default spread to the 7.43%, in which case you're double punishing India for default risk. Or the third, which is the right thing to do, is take out the default spread, which would give me a risk-free rate of 5.28%. My risk-free rate in Indian rupees, if I'm valuing a company on January 2nd of 2019, is 5.28%. Am I being blind to the fact that India is risk? No, there are plenty of places, as I said, where I can bring that in. I've got equity risk premiums and default spreads and all that risk stuff coming. The risk-free rate should not carry the burden of country risk, and that's what. Now, the reason I do this is I think there's a heck of a lot of double counting of risk. I'll give you a much more extreme example than India. I was in Nigeria a few years ago valuing a Nigerian company. In Nigeria, the currency is, do you know, does anybody know the Nigerian currency? The Naira. The Indian government, the Nigerian government bond rate in Naira was about 16%. 6% of that was default spread. It was just a very risky country. Let's say I value a Nigerian company, PZ Cousins Nigeria, Nigerian Consumer Product Company. Let's say I start with the 16%. Why? Because I'm doing what I was taught to do, use the government bond rate. Finish the rest of the process, what do? I bring in a beta for the company, and then I bring an equity risk premium for the company. And guess what I bring in as an equity risk premium? The equity risk premium for Nigeria, which is this huge number. I think we're actually counting Nigerian country risk twice then, once through what we call the risk-free rate, but it's actually this government bond rate, and once through the risk premium. So this is really a process for cleaning up. Right? I'm not trying to bend over backwards and make the country look better. I'm just saying don't double count the risk. Now do you see what I'd have had to do if the US government had dropped to AA, or if I wanted a risk-free rate in US dollars, then what would I need to do? I'd have to take the T-bond rate and subtract the default spread for it. In fact, that's what I have to do with British pounds now. I used to be able to take the British pound rate as a government bond rate, the UK government bond rate, and use it as my risk-free rate. I can no longer do that because the UK has lost its AAA rating pretty decisively. Every rating agency has dropped it. So today I have to do what I do with the Indian rupee with the British pound. So let's talk about these default spreads, because these default spreads are going to come into play not just with risk-free rates, but also when we talk about equity risk premium. So I'm going to give you ways in which you can get a default spread for a country. The first is if you have a country that either issues dollar or euro denominated bonds, you might be able to get the default spread by looking at the interest rate on the bond. Much of Latin America, for instance, Brazil, Peru, Colombia, not Venezuela, the government issues dollar-denominated bonds. So as an example, if you take Brazil, you can get the Brazilian dollar-denominated bond. So this is a Brazilian government 10-year bond in dollars. Let's say the rate on that bond is 6%. The T-bond rate right now is 2.6%. You subtract the you see why it's subtracted out? They're both dollar-denominated bonds. This is not real versus dollar. They're both dollar. The difference has to be because of default risk. Earlier we talked about Italy, right? 2.91% euro bond rate. The German euro bond rate is 0.2%. What's the default spread for Italy? The difference between the two numbers, 2.71%. So if you have a dollar or a euro denominated bond, you can compare it, the dollar bonds to the UST bond and the euro bonds to the German euro to get a default spread. That's going to give you default spreads for probably 25 countries, maybe 30. But there are 160 countries. So let's keep reaching. The second is you can go to a market called the sovereign CDS market, credit default swap market. It's a fancy way of saying insurance market. Basically, this is a market where you can go buy insurance against default. So let's say you have a Brazilian government bond and you're worried that the Brazilian government will default. You can go to the sovereign CDS market and buy insurance. Buy insurance, which means you got to pay. And how much you pay, the way the CDS market is structured, is they will take a portion of you. So let's say you collect 9% as your coupon on a government bond. On the CDS market right now, the Brazilian CDS might be 3%. So every year when you collect your 9%, they will take the 3% away. It gives you a market set measure of the default spread, and it's going to change every minute of every day. It's actually fascinating to watch those spreads around events, right? When Turkey had that mini, where nobody knew what was going on, the CDS spread. So it's unlike the rest of the world, which is kind of frozen. This actually will give you an updated default spread. When Egypt had its, the political spring where Mubarak was removed, the CDS spread reflected it. When Ukraine had the problems with, so sovereign CDS spreads are market set default spreads, but they're available for only about 70 countries right now. It's good, it keeps growing, but it's 70 countries. So we're getting from a government bond in dollars and euros, about 25 countries. Now we're to sovereign CDS spreads. We can get to 70 countries. But there's still about 90 countries out there. So I'll give you the third way you can do this. With countries which have neither sovereign CDS spreads nor government bonds in dollars or euros, many countries still have sovereign ratings. Moody's rates about 150 countries. If I have a sovereign rating for your country, I can look up a typical default spread based on the rating. Am I happy with that? Well, I'd prefer that it was a market set number, or I can look it up, but if this is the best I can do, I'm still going to take it. So let me give you an example of how this would have looked like at the start of 2019. Start of 2019, these were all the currencies in which I was able to find a 10-year government bond in the local currency. There are lots of currencies where there are no government bonds. We'll talk about what to do with those currencies. But these are the currencies in which I was able to find a 10-year government bond, and these are the rates on the local currency bond. So let's pick Brazil. Right? Start of 2019, the Brazilian government bond, 10-year government bond, was 9.18%. Remember, that's not a risk-free rate, that's a government bond rate. What do I need to get a risk-free rate? I need a default spread. And with Brazil, I can get all three measures of the default spread. Let's get them to see how different they are. First, I can look at a Brazilian 10-year government bond, and at the start of 2019, the 10-year US dollar denominated 10-year Brazilian bond was 3.98%, which if you subtract out the T-bond rate on that day, which was 2.68%, gives me a default spread of 1.3%. So if you trust the government bond, it looks like the default spread for Brazil is 1.3%. So everybody with me so far? That's with the government bond. If I go to the sovereign CDS market, the default spread at the start of 2019, the sovereign CDS market for Brazil, was 2.87%. But there's one catch in the sovereign CDS market that makes it tricky to make the leap to default spreads. The sovereign CDS market is a market, unlike the futures and the forwards market where the exchange actually backs up your contract. In the sovereign CDS market, there is credit risk. You know what I mean by credit risk? You buy insurance. The insurance is only as good as the person who sold you the insurance. In fact, in 2008, the market almost imploded because Lehman was such a big seller of CDS spreads that when they went bankrupt, the market almost went down with it. So you think, so what? So the price you see in the CDS market reflects some of that credit risk. So the 2.87% for Brazil might be too high because some of it is for credit risk. You say, how am I going to back that up? I went to the US. If I take the assumption that the US has no default risk, the only reason you see a sovereign CDS for the US or Switzerland is because of the credit risk in the market. It's about 0.3%. I subtract out the 0.3% from the 2.87%. So think of that as a cleaned up measure. So if you don't like it, just stay with the 2.87%. I'm trying to get a measure of default risk by looking at the sovereign CDS market. So remind me again what it was with the government bond. Using the government bond, my spread was 1.3%. Now I'm getting a very different picture from the sovereign CDS market, 2.57%. Saying which one should I use? Hang in there for just a moment because I'm going to give you a third number. What's the third way I can get the default spread? I can look at the rating for Brazil and look up the default spread that goes with that rating. And the rating for Brazil I think is BA2. It's dropped significantly in the last 3 or 4 years because of political crisis. And with the BA2 rating, the default spread should be, so this is my lookup table, 3.39%. 1.3%, 2.57%, 3.39%. Now, which number I use will give me very different risk-free rates, right? Remember, I'm going to subtract this from the risk-free rate. If I use the 1.3%, my risk-free rate in reais is 7.88%. If I use the 2.57%, the risk-free rate is 6.67%, 6.61%. If I use the 3.39%, my risk-free rate is 5.7. This seems like a huge decision, right? My suggestion is don't angst over it. And here's why. If I just focus on the risk-free rate, which one is my most favorable number? Which one would I use? Because remember, from a valuation perspective, I want a low risk-free rate, right? So I'll go with the 3.39%. You're congratulating yourself on pushing up the value. Not so fast, because when you get to the equity risk premium part and I ask you what the risk of Brazil is, you're now trapped. Because now you can't go back and say, let me use the 1.3%. If you use the 3.39% to come up with your risk-free rate, when you come up with an equity risk premium, I'm going to go back to that saying, so what one hand gives, the other hand will take away. So the lesson here is pick one, stay consistent. If you want to average them out and use them as a default spread, I have no problem. The one thing I cannot live with is one approach to get the default spread to get the risk-free rate and a different one to get the default spread to get the equity risk premium, because that's when you're going to get into trouble. Yeah.
In the case of a country that's sanctioned, like Venezuela, how would you go about, like, this is...
Venezuela's smallest. The sanction is the least of Venezuela's problems. We'll talk about it because in a sense, it's not just those countries. You know, there are 120 currencies here where there's no government bond at all. I can't use any of these approaches. So I'm going to give you a generic approach you can use in any currency. And when you try to apply to the Venezuelan bolivar, it's going to freak you out. But it's not the approach's problem, it's the Venezuelan bolivar's problem. So we'll talk about why. But we'll talk about what to do when you can't use any of these approaches, because there are lots of currencies where none of these approaches will work. But I want to make sure the mechanics of what I'm doing are clear. Start with the government bond rate, clean up for the spread, but there are 3 different approaches and they can give you 3 different answers. Okay. Now before I give you that more generic approach, in Latin America, because of their experience with inflation, especially over the last 50, 60, 70 years, a lot of Latin American companies and analysts, especially in the 1990s, in the last century, now the first decade of this century, moved to doing everything in real terms. You know what that means? Basically, all they just ignored inflation entirely. Basically, when they did revenue growth, it had to come from selling more stuff, not from pushing up prices. So you basically estimated cash flows in real terms, and they want a real risk-free rate. Remember I showed you the TIPS rate? Let me explain how a TIPS bond works. If you buy an inflation-protected treasury bond, the rate right now is 0.88%. You're saying, what does that mean? That sounds really low. The coupon is actually not 0.88%. What you will get as your coupon next year will be 0.88% plus whatever the inflation is for the year. So next year, if the inflation is only 1%, you'll make only 1.88%. If the inflation is 10%, you'll make 10.88%. So in other words, the 0.88% is guaranteed. The inflation is added on top. Now do you see why this is a real risk-free rate? Because you're guaranteed the 0.88% no matter what the inflation works out to be. That's my risk-free rate. You're saying, but it's in US dollars. Once you remove inflation, currency ceases to exist. 0.88% is a real risk-free rate globally. And if I value a company in Brazil, in Indonesia, in India, I can use the same risk-free rate with one caveat. For real risk-free rates to be the same globally, here's what has to happen. If the real risk-free rate is 5% in one country and 0.88% in another, capital should flow out of the 0.88% country to the 5% till they equate. Okay? So in a world where capital can flow freely across countries, risk-free rates are going to converge. And across 70% of the world, that's going to happen. So you ask me what's the real risk-free rate in Europe? It's going to be very close to real risk-free rate in the U.S. because it's not capital flowing in the sense stocks and bonds and money will move out of markets. But if you ask me what's a real risk-free rate in India, where capital constraints then it's a little dicier to use the 0.88%. You're saying, what would you use instead? There's an approximation that I'll talk about with currencies to get to a risk-free rate that you might use instead. But this is the only true observable risk-free rate, is the TIPS rate, and if you're really stuck, I would use that as your risk-free rate. So now let's talk about the troublesome scenarios. When you have no default-free entity, you can do what I did and start with the government bond rate and back out from it. Right? You can do the analysis in real terms and act like but let's face it, doing things in real terms doesn't make inflation go away. If you're in a country with high inflation, it's like having an elephant in your living room. When it moves, you will notice. Putting a big blanket over the elephant, and I see no elephant, doesn't. So doing things in real time doesn't make the problem go away, it just shifts it to somewhere else in the analysis. Or you can cop out. If you really get into serious, so if you're in Venezuela, you say, look, I can't get this Bolivar risk-free rate. Here's an escape hatch. Currency is a choice. I can value any company in any currency. You give me Infosys to value. I don't have to value in Indian rupees. I can value in US dollars. You give me Tata Cement to value, same thing. I can value any company in any currency. And if I'm truly desperate, that's what I'm going to do. But it is a bit of a cop-out, right? Because you have to deal with the local currency. So let's talk about getting risk-free rates in the local currency when you don't have a government bond rate or you don't trust the government bond rate. You know what I mean by don't trust? I was looking at the list of government bond rates that were reported for different governments. And The Economist claims that the Venezuelan 10-year government bond rate in Bolivar is 21%. If you really think that this is a market set rate, you're operating on a universe very different from mine because nobody is going to buy a Venezuelan government bond in Bolivar and accept a 21%. I mean, this is a country where inflation is what, 5,000% a month? So you're saying, but where's that rate coming from? In many countries, what you see as a government bond rate is really not coming from a trade. These are not T-bond markets. We have demand and supply. They're often government set numbers and there's very little liquidity. So if you don't have a government bond rate, or you don't trust the government bond rate, here's what you can use instead. You can try to come up with what I call a synthetic risk-free rate. What's a synthetic risk-free rate? Remember that TIPS rate that I have, 0.88%? You take the 0.8% and you add on expected inflation. Because ultimately, if you think about interest rates, there's an expected inflation and expected real interest rate component. You take the TIPS rate as your real interest rate, add the inflation in that currency. So if you have 10% inflation in your currency, your risk-free rate will be the 10 plus 0.88, 10.88%. I'll give you an even simpler trick that I find incredibly useful to switch across currencies. If you ask me which currency do you feel most comfortable with the risk-free rate, I'd probably say the US dollar, simply because I work in US dollars the most. So risk-free rate right now in the US dollars is about 2.6%. That's a T-bond rate. Let's assume that you want to get a risk-free rate in Egyptian pounds. There are no government bonds in Egyptian pounds that I can look up, nothing that I can trust. But here's all I need to do. I'm going to start with the US T-bond rate as my dollar risk-free rate and take the difference in inflation between Egypt and remember, it's all about inflation. So if inflation in Egypt is 15%, inflation in the US is 2%, 15 minus 2 is 13%. I can take the 13% and add it on to my US T-bond rate, and I've got a risk-free rate in that currency. I can go from a dollar risk-free rate to any other currency if I'm willing to estimate inflation. In fact, I do this on my website by taking, if you go to the IMF, the International Monetary Fund, they have projected inflation for the next 4 years in 200 different currencies. I know how trustworthy these numbers are. I just take them and run with them. So you can take the expected inflation, subtract other inflation in the US, and come up with risk-free rates in all 200 currencies. So what's the inflation rate you think in Venezuela? Let's come up with the Bolivar risk-free rate then.
It's estimated to be 10 million this year.
10 million this year. So your risk-free rate is going to be 10 million plus. You're saying, what company is going to be worth anything at 10 million plus? Well, if you can pass it through to your customers as higher cash flows, maybe you can survive. Very few companies can, which is part of the reason business is dying in Venezuela. Nobody wants to make long-term decisions. So if your inflation is high, it's going to translate into high risk-free rates. So I've actually given away the answer, but I'm going to cheat and show you the question again. These are actually my estimates. See the green numbers? Those are my estimates of the risk-free rate in 40 currencies at the start of 2019. Okay. Yep. We'll come to that. Actually, hang on, because I'm going to use this to talk about negative risk-free rates. Okay. So I have risk-free rates in 40 different currencies. Let's start with the obvious statement. Risk-free rates vary across currencies. There are low risk-free rate currencies like the US dollar and euro. There are negative risk-free rate currencies like the Swiss franc and maybe the Czech koruna, maybe the Japanese yen. There are very high risk-free rate currencies like the Nigerian naira. So here's my question, and I already gave away the answer, so you can bounce my answer back. Why do risk-free rates vary across currencies? It can't be because of the risk of the country, because I've cleaned up. Remember, these are cleaned up risk-free rates. It has to be differences in inflation. High inflation currencies have high risk-free rates. Low inflation currencies have low risk-free rates. And deflationary currencies could have what? Negative risk-free rates. So the question, can risk-free rates be negative? Yes. Is it unusual? Yes. Is it unnatural? No. In fact, I wrote that post on negative risk-free rates right after the Swiss franc and the euro rates became negative. Because people were again freaking out. How can this happen? This is not, I've never seen this in my Econ 101 class. If you have enough deflation, but there's another component that has to come in. If you have to have deflation and really low economic growth. If you have deflation and really low growth, you're going to get, and it's not a good thing. When risk-free rates get really low, that's bad news, not good news, because it reflects the fact that expected real growth is low, and on top of that, you have very little inflation. So can risk-free rates become low? Yeah, 2.68% is low. And a lot of people want to normalize this by looking at what the rate was in the last 20 years, last 30 years, last 50 years. In fact, a couple of appraisal firms have been replacing the T-bond rate with a normalized rate, 4 or 5%. And the reason is very simple. We normalize everything else, profit margins, revenue growth. Why shouldn't we normalize risk-free rates? Why shouldn't we? I think it's horrifically bad practice. So I've kind of biased the answer anyway. But why shouldn't we just normalize the risk-free rates? Let's play this through. Let's suppose I replace today's 2.68% risk-free rate with a 5% normalized rate. Lead me through what's going to happen next. I'm going to end up with much higher cost of equity, much higher cost of capital, much lower value for companies, right? In fact, my guess is you're going to find most companies are overvalued. And we know what you're supposed to do when your companies are overvalued. You take the money and you put it into the risk-free investment. And you're going to earn what? 2.68%, not that magical 5%. If you can find me this magical T-bond that earns 5%, I'm glad to go there, but this is like a unicorn. I'm never going to find it. So I don't think it's a good idea to mess with risk-free rates. You know how many market participants I say this to, but the Fed. That's always but the Fed has kept rates low. Has the Fed kept rates low for the last 10 years? So what's kept rates low for the last 10 years? And why does the market have, what did I say goes into risk-free rates? Remind me again, inflation and real growth, right? Every year I update this graph, and you can tell me what this graph tells you. Basically what I do is I take the inflation rate every year in the US, I take the real GDP growth every year, and I add the two numbers up. So as an example, if your inflation rate is 1%, and your real GDP growth is 2, 1 plus 2 is 3%, I call the sum an intrinsic risk-free rate. See this black line there? That's my intrinsic risk-free rate. So that's just adding inflation to real growth. You see the red line? That's the actual T-bond rate. Do you think the two move together? It looks like they do, right? So if I look at the last 10 years, since 2008, what do you notice? Low inflation and low growth. Low inflation plus low growth gives you low interest rates. Could the Fed have an effect? Yes, at the margin. If inflation had been 5% in the last 10 years, there is no chance that the Fed could have kept rates at 2.5%. You know why? What's the only interest rate the Fed controls? It's called the Fed funds rate. In fact, while I was the Federal Reserve, I asked the person, can you take me to the window where I can borrow the Fed funds rate? She said, there's no window. It's called a window. And only banks can borrow there. And it's an overnight rate. So all the Fed controls is an overnight rate at which banks borrow. So how does it affect interest rates? The power of the Fed comes from the perception that it has power. In fact, I call Ben Bernanke the Wizard of Oz. And I'd call any Federal Reserve chair the Wizard of Oz. If you remember the movie, the Wizard of Oz had no power, but the perception that he had power made him powerful. The power of central banks comes from the perception that they have power. So they have to actually get ahead of the market. Lower rates when rates are going to go down anyway. Raise rates when rates are going to go up anyway. Because you really can't do much to alter the fundamental movement of rates because that's driven by inflation and real growth. So when people get caught up in these, there's an amazing amount of conspiratorial theories there. The Fed is doing this, the Fed is doing that, let's watch the... Just stop talking about the Fed. Take care of investing as you have to do it because the Fed has become this excuse for portfolio managers. Ask portfolio managers, how come you've been doing so badly? For the last 10 years, active investing has hit the skids. It's an extended, it's not just, it's been happening for a long time, but the last 10 years, it's obvious they've hit the skids. And we asked them to a person, they all blame the Fed. It's the Fed's fault. No, it's not the Fed's fault. It's your fault. Let's start taking responsibility for decisions and stop blaming the Fed. So when you think about risk-free rates, it's at one level very simple. Another level, the risk-free rate is not just a number. It's also the conveyor of expectations of inflation and real growth into your valuation. So if you have a really low risk-free rate and assuming a really high growth for your company better be special because it has to grow fast in an economy that is growing slowly. Yes?
Another question for you. You said the risk-free rate is made up out of inflation and real growth, right? This year, the United States, in 2018, the United States experienced higher than usual real growth. I'd say pretty high. I think like 3.5-ish, right, for the whole year, the average out.
The risk-free rate is a 10-year rate. Do you think the U.S. can grow at 3.5% for the next 10 years?
No, I don't. So I was asking, how does that measure up in terms of the actual risk?
This is actually the largest gap I've seen between an intrinsic risk-free rate and an actual risk-free rate. The actual risk-free rate is 2 point. Did everybody get his question? If you look at the real growth and inflation in 2019, it looks like the risk-free rate should be, I think with my calculation, about 4.5%. It's actually at about 2.5%, which is the biggest gap I've seen. So one of three things has to be true. One is that the T-bond market is just too pessimistic. Maybe they got the China problem into their head and pushed down the rates. Maybe that's... The second is maybe what you're seeing as growth in the U.S. economy is a brief growth and then it's going to relapse down to... Because remember, the bond market's job is to predict growth over the next 10 years, not over the next year. Okay? The third, and I think this is the most likely answer, is there's some truth to both of the first two. I think the T-bond market rate, especially, because remember the T-bond rate was 3.2% on September 20th of 2018. Between that day and the end of the year, while the stock market was collapsing, why? Because, come on, whenever you don't know the answer to the question, just say China. Works pretty well. The T-bond rate was also dropping. So I think just like stocks overdid it, bonds overdid it too. Okay? But I think that this year, my prediction is you're going to, by the end of the year, see rates close to 3.5%, because I think that's a more realistic estimate of what rates should be. So it's not because I think the Fed is going to tighten, because I think by focusing on the Fed, we lose sight of the things we should be focusing on. Growth and inflation is what ultimately drives risk-free rates, and that's why if you're in Europe, you have to be depressed by what the bond market is telling you, because the bond market is saying there's no growth and there's close to zero inflation. That's not a healthy place for an economy to be. And I think that, I've told people, I know we're back, because remember, this era of 2.5%, 3% rates came after the 2008 crisis. I've told people, I know we're back to health when I see T-bond rates at 3.5% to 4%. Because that is more consistent with a growing, healthy economy than a 2.7% rate. And my guess is by the end of this year, one or two things are going to happen. Either we're going to go into recession in the global economy that's going to push down growth in the U.S. down towards the 2.7%, or you're going to see a rise to a 3.5%. Maybe they'll meet somewhere in the middle. Yeah. Yes?
I know you said that a lot of it has to do with like the discount window, but I'm just curious with the Fed and its balance sheet. Don't you think
Yeah,
that
just
should
don't
be-
worry about see, I'll tell you what, there's the other story. The Fed has a lot of bonds on its balance sheet. If it sells the bonds, will there be a liquidity effect? The T-bond market is so huge. I've heard the same thing about China. China's the other one, right? China owns a lot of US T-bonds. Couldn't they cause... this is one of the deepest, widest markets in the world. To have a price effect in the T-bond market takes an incredible amount of money. So unless the Fed panics and tries to sell all of its bonds overnight, which I don't see why it would, there are ways in which the Fed can back out of its balance sheet problem over time without causing the kind of jump in rates that people are predicting. So I think the Fed balance sheet worries me less than real growth and inflation. My concern is if inflation comes back, because the economy is growing too fast, then you're going to see T-bond rates rise. But you're going to see T-bond rates rise with or without the Fed.
So you're saying it's less monetary policy effect, more just like productivity and economy?
Monetary policy affects inflation. So, so it's less Fed effect. So I'm saying inflation is still because it is a monetary policy. But the Fed effect is much more short term. The perception that the Fed will tighten or loosen things, I'm saying that's a transient and more of an incremental effect, not the key effect.
So it's more perception in the system.
Exactly, exactly. You know when central banks really get into trouble? Is when people perceive them to be weak. The Japanese central bank is done. Nobody cares. They tighten, they loosen, people say, oh, who cares? Right? That is what central banks have to be careful about, is if that perception of, it's like the Wizard of Oz. The curtain falls, there's a little guy pulling, there, your power is gone. So the Fed has to maintain this illusion. So the Fed doesn't dislike the fact that everybody thinks it's this powerful entity. It actually serves their interests really well. So there's, if I were a Fed board member or chair, I would talk like Alan Greenspan, which is say a lot and say nothing. That guy was capable of talking 2 hours and you had no idea what he'd said. Right? So now let's move on to the next phase. So think about risk-free rates, that's the first piece. Let's talk about equity risk premiums. I'll tell you what the equity risk premium is supposed to measure, and then we'll look at different ways of doing it. Equity risk premium is what you would demand over and above the risk-free rate for investing in equities as a class. So let's take the US. Right now I said the T-bond rate is 2.6%. So when I ask you what's the equity risk premium in the US, I'm asking you how much more than 2.6% would I need to offer you to buy equities. So let's make some very basic statements about the risk premium. First, that risk premium should be greater than 0. Because if you can make 2.6% guaranteed, you'd be crazy to settle for less than that on an expected basis. After the fact, you might end up with a lower return. Second, it should probably go up in periods when people get more risk averse and go down when people feel better. So when you have crises, the way it's going to show up as a higher risk premium. And third, it should vary over time, right, because of the first two. So let's talk about the way in which most people estimate equity risk premiums and why I don't think it works anymore. The way in which I was taught to estimate equity risk premiums, and you probably were taught the same thing in your foundations class, is to look backwards. To compute what's called a historical risk premium. And the data service that used to carry this data was a service called Ibbotson that everybody used. It's now Duff and Phelps. Well, basically, here's what you're doing. You're looking at the last 50, 60, or 70 years, and you're asking two questions. On average, what would I have made investing in stocks over that 50-year period? Let me throw a number out, 8%. On average, what would I have made investing in T-bonds? Let me throw out another number, 4.5%. Then you take the difference between those two numbers, 8 minus 4.5, and that's your historical equity risk premium. Sure, Matt. You're saying that should be pretty straightforward. Let's compute a number. I'll give you the historical equity risk premium for the US, and I'm going to give you 12 different numbers ranging from the low of 3% to a high of 13%. These are all technically historical equity risk premiums. So how come they're so different? It depends on three choices I had to make. One is how far back in time I was going. Going back to 1928 gives me a very different risk premium than going back to 1960 or 2008. It depends on whether I compare to T-bills or T-bonds. T-bills are short-term, T-bonds are long-term. And third, it even depends on how I compute my average returns. Do I take a simple average, an arithmetic average, or take a compounded average, a geometric average? You're saying, which of these 12 numbers should I use? My answer is none of them, because they're all crappy. And here's what I mean by crappy. Remember statistics, if I give you 80 numbers and ask you to compute an average, if this were a statistics class, what are you required to put in brackets below your average? A standard error, to tell the world this is how much uncertainty there is in the average. Let me do some stat 101. See this risk premium of 4.66% that I get by going all the way back to 1928, that's 90 years of data. If you trust that data, stocks made 4.66% on a compounded basis over T-bonds over 90 years. You're saying, this is good, I have my risk premium. Hey, before you get too excited about it, the standard error in that number is 2.22%. So let's do some stat 101. My estimate of the risk premium is 4.66%. The standard error is 2.22%. If I ask you for a range on the risk premium, plus or minus 2 standard error is a pretty standard statistical range. The true risk premium for the US, if I go all the way back to 1928, could be anywhere from 0.5% to 9.5%. Fat lot of good that does you. That's if I go back all the way to 1928. If I go back to 2008, the equity risk premium is 11%. This is exciting, huge risk premium, right? But the standard error in that number is 5.5%, which means it could be 0, it could be 22%. Historical risk premiums are not facts, they're estimates with standard errors, and you can already see how much of a range there is. In fact, if you think about why historical risk premiums, one is the standard error issue. The other is a more subtle issue. What was the most successful equity market of the 20th century? Not this century, but the 20th century. It was the US. And I'm looking at the risk premium in the most successful market and saying, I made a lot of big premiums. You see the danger of doing this? If I now take that premium into other markets, I'm not only assuming that this market that I'm looking at will be one, like the US, most successful market of the 21st century, there's a selection bias here. So if I want a historical risk premium then, I should be looking at the US, but I should also be looking at Austria. Because in 1945 or 1939, Austria was a pretty big equity market, but I'd have lost all my money during the Second World War. So in fact, the London Business School has computed historical risk premiums for a 100-year period for 22 equity markets for the 20th century. And what they found, looking across the 22 markets, was if you look at the entire globe, the historical risk premium, stocks over bonds, is closer to 3.2%. Much lower than what we get for the US, which is what you'd expect, because the selection bias will mean that even if you want to go with the historical premium, that historical premium is going to be too high because you picked the most successful equity market of the 20th century. Again, I'm trying to give you ammunition, because when you get in your job, on your desk, there are people who are going to come with a historical risk premium. So risk premium is 5.63%, second decimal point. Don't let them, even if they're your boss, do it subtly. You don't want to lose your job. No, that 5.63% is not a fact, it's an estimate. Ask them where they got it, over what time period. Try to explain to them the standard error, and the selection bias might go above their heads, but no, basically that 5.63% tells me very little about the future. There's one final point I want to make. When you use a historical risk premium for the US, as you project, because that's what you're doing, right? You're making the projection for the future. What are you assuming about the future? It's going to look like the past, right? It's called mean reversion. And for 90 years in the US, that is the way people have done things, mean reversion. Why do you buy low PE stocks? Because you assume over time they will move to the average PE. And mean reversion works until it doesn't. For mean reversion to work, the basic structural model has to stay stable. Right? You're reverting back. And between 1945 1945 and 2000, the US had the most mean reverting stable structural model in history. No economy in history has been that stable and that predictable. Until 2008, I would let people use a historical risk premium and I'd say, okay, that's how you were taught, I'm okay with it. Since 2008, I pushed back. Do you see why 2008 was a breaking point? Because I think it was a structural break. This wasn't just a crisis. It was a message to us, this isn't the 20th century anymore where the US is half the global economy. It basically is an economy where you can have a shock in China, percolate all the way through the world, a shock in Venezuela, affect oil prices. That tells me that even if I have the historical data, using that historical premium might be a dangerous way to estimate risk premiums for the future. If I said this to an analyst, their response is, what choice do I have? I won't get to this session, but in the next session, I'm going to give you an alternative to historical risk premiums. That's a forward-looking dynamic number, because that's what we need to move towards, not this backward-looking static mean reverting number, but this is the historical risk premium basis. Excuse me. But let's stay with historical risk premiums, at least for the moment. If you need a lot of history to get a historical risk premium, remember I needed 90 years of history in the US even to get to 2.22%. If I ask you what the risk premium is for Brazil, or I was in Vietnam last year, what the risk premium is for Vietnam, you can already see historical risk premiums are not going to help me. If I wanted a historical risk premium for Vietnam, how many years of data do you think I'll have? 30, no chance. 30 years ago, Vietnam was still completely a economy. There was no market. It's 8 years of data. And 3 of those years are not even usable. So you have 5 years of data. What kind of historical risk premium do you think I can get that actually can be usable? So when you get to emerging markets, don't even look for historical data, because even if it's there, it's not trustworthy. You can get historical data for India, but the 1960s and 70s, this was a market dominated by maybe 7 companies. There was not much liquidity. So basically, historical risk premiums are a non-starter. So if I come to you with a Brazilian company and ask you what the risk premium for Brazil is, you have 2 choices. You can ask me to come back in 83 years, because by then you'll have a lot of historical data, and then you'll do my valuation. I'd strongly recommend that you don't do that. Or you can try to do something today. So I'm going to give you 2 ways in which you might be able to estimate a risk premium for a Brazil or a Vietnam. Let's start off with the foundation. Let's assume that you find a way to estimate a risk premium for the US. Let's even take the historical risk premium. Let's say that historical risk premium is or the risk premium for the US is 5.96%. So you feel pretty comfortable with that number for the US. And then I ask you, what's your risk premium for Brazil? Here's the first way I could do it. I could take that, remember the default spread I took out of your government bond rate to get to a risk-free rate? I could take that default spread of 3.39%, I told you to revisit you now, okay, and add it to my US risk premium to come up with the risk premium for Brazil. This is the way most investment banks compute risk premiums for emerging markets. They have a US-based premium, and to that they add a default spread, either from the sovereign CDS market or from looking at the ratings onto that number. So when I first started valuing emerging market companies, I looked at this, and one thing troubled me. That 3.39% is a spread that you're demanding for buying a Brazilian government bond, right? But you're not thinking about buying Brazilian government bonds, you're thinking about buying Brazilian equities. So let me ask you a generic question. Are equities riskier than bonds or safer than bonds? They're risky simply because the equity guy is always the last guy in line. So if I'm demanding 3.39% for investing in Brazilian government bonds, I would expect to be demanding a little bit more for investing in Brazilian equities, which leaves me to a dead end. We say, how much more? So here's what I did. I look up 2 numbers. I look up the standard deviation, the equity index. For Brazil, that's the most widely used index, is the Bovespa. And let's say the standard deviation, the equity index is 30%. Then I look up the standard deviation in the Brazilian government bond, and it's 18%. Let's do an algebra problem. The spread I'm charging for buying the Brazilian government bond is 3.39%, but the standard deviation of that bond is 18%. If I'm investing in equities, which are about 1.6 times more risky, that spread is going to be much greater. So, that spread is going to be much greater. In fact, the spread I get is 20, so let me reset. So I have the standard deviation of the Bovespa, the standard deviation of the Brazilian government bond of 20%. The equity index is 1.5 times more risky than the bond. 3.39% times 1.5 gives me a risk premium of 5.09%. You add that onto the US premium, you get a risk premium of almost 11%. I skipped a page, so let me go back to the middle page. This is the third way I can get a risk premium for a country. I have a 5.96% risk premium for the US, and the standard deviation, the S&P 500, is, let's say, 18%. Let's say the standard deviation of the Bovespa is 30%. Basically, I'm going to take the 5.9, again like an algebra problem, I take the 5.96% and I scale it for the additional riskiness of the index. So let me summarize. 3 ways in which you can get country risk premiums. One is just go with the default spread, add it onto the US premium. The second is take the US equity risk premium and look up the standard deviations in both the S&P and the local equity index and use that ratio to come up with it. This is an approach that Goldman Sachs popularized. I'll tell you one of the weaknesses of the approach. Using this approach, Pakistan has a risk premium of only 3%. You know what? The standard deviation of Pakistani equities is half the standard deviation of the S&P 500. Does it surprise you? It doesn't surprise me in the least. The Egyptian standard deviation used to be close to 0%. What are we computing standard deviation in? Prices, right? For prices to change, what do you need? You need trading. If you have a market that's completely illiquid, guess what the standard deviation of the market will go towards? 0. The danger of computing the standard deviation of an emerging market of the US is you're comparing an illiquid market to a liquid market. You might understate the equity risk premiums for markets where illiquidity is a real and present danger. So the second approach, the Goldman approach, I almost never use because comparing standard deviations across countries bothers me. But within that same market, because if one is not traded, the other is not going to be traded as well, I feel more comfortable looking at government bonds as opposed to equities, because if one is illiquid, the other tends to be illiquid as well. So this is my framework for computing country risk premiums. And using that framework at the start of every year, I estimate equity risk premiums by country. And I cut some corners. So at the start of this year, for instance, I wanted to estimate equity risk premiums for country. I'm going to talk about how I get the risk premium for the US, but let's start with that, 5.96%. I'll take you through that process of how I got the base number. Then I take every country that has rated and I look up their Moody's rating to get a measure of the Moody's. If they have if they don't have a Moody's rating, they can give me a country risk score, I convert into a rating. But basically my job here is to come up with a rating for every country. I use that rating to come up with a default spread for each country. If it has a sovereign CDS, I check to see if it's close enough. If it does not have a rating, then I use a country risk score to come up with something like a rating. So here's where I am. I have the US risk premium. I now have a measure of country risk in terms of default rate. I convert the rating into a default spread. So just like I did for Brazil, I have a default spread for each country. I initially used to try to look up the government bond and the equity index volatility in each country. I very quickly gave up on it because many of these bonds there's no trading, you can't find any data. So I've started to use a bludgeon approach, and here's what my bludgeon approach looks like. I was able to find 2 indices. They're both S&P indices. One is an index of emerging market equities collectively. The other is an index of emerging market government bonds. So that you can get the data for this on the Federal Reserve side, Fed. The ratio of emerging market equity volatility to emerging market bond volatility is about 1.23. I'm going to apply that as my scaling variable to every country. You can see why this is a bludgeon. I should be doing this by country, but without the data, I can't do it. So here's what I have. I have a 5.96% base. Let's say the default spread for your country is 2%. I'm going to take 2% times 1.23, which gives me 2.46%. And I'm going to add that 2.46% to the 5.96%, which gives me an 8.42% risk premium for your country. And I do this for every country. I know you're tired, but I'll leave you with a picture. This is the world as I see it at the start of 2019. Equity risk premiums by country broken down across the world. You can take any part of the world. Look at Latin America. The black numbers are the equity risk premiums. The red numbers are the country risk premiums using the approach I just described. Okay? When we come back on Monday, one of the things we're going to do is take these risk premiums, okay? Take these risk premiums and use them to come up with risk premiums by country. So if you get a chance, we went through a lot of stuff today, so I would like you to go back and review the material, play with the numbers, get comfortable, because we're going to build on it on Monday. Okay? They don't. They just add you to the list. Why would they send you an email? They just add you to the... So you're registered already? Okay. You're getting the emails? Then you're all set.
I'm just curious if you can take a normal distribution of GDP growth, like globally, and then find out where in the market cycle we are.
Distribution across countries or distribution across time? You got to be very
Like
careful.
each specific country, and then
Time series.
yeah, and then find out
How would you get a normal distribution? You get a distribution, an empirical distribution.
yeah,
How do
and
you
then find like S&P returns based on because it should be roughly correlated with GDP growth, right?
No.
No.
It's the uncertainty issue, right? Risk premiums are not driven by level of growth. They're driven by uncertainty about growth.
So we can't find out correlation between like a ratio.
You can, but it doesn't have to be,
It
right?
doesn't have to.
Yeah.
Thank you.
Yes. Let me go because I think they were setting up. Let's go out this way.
I wanted to ask you the update if you get like from admin.
back in the booth, so once we get them mic'd up, I can cue them